Morning, everyone. Good morning, YouTube. Good morning, traders. I hope everyone's doing well. And we have not too much to talk about today. There is one main Fed thing that I do want to mention, but other than that, I don't really see too much news until we have the midweek point and then the end of the week when we have those NFPs. So there's a few things, right? We have I would take a look at also home prices and the Fed. That's the main two topics of conversation today. Then we'll go over some levels, some areas of interest, and what we could see fit for the day. Now, yesterday we had a very key level at the 405 on the SPY for like 40.55-ish, right? 40.57-ish on the S&P futures. That held out really well for that massive resistance where prices were just like sustaining. And what we were looking at was for that key level to hold out for the market makers. We'll see how that shapes up today. But there could be somewhat of dip buying after Friday's massive move to the downside. So what we have this week is that the main topic of conversation is that quantitative easing, quantitative tightening, QT is actually starting to increase, right? We had a massive downturn in the Jackson Hole, right? That rippled pretty much throughout the markets, and investors are still eyeing a little more movement and tightening policies from the Fed, and that's exactly what we're going to see this week. So, from that central bank, the Federal Reserve this week is set to increase the pace at which quantitative tightening. I keep saying quantitative easing. It's just so ingrained, but quantitative tightening is set to unwind, right? They're unwinding the balance sheet through a pickup in the quantitative tightening program. So the move is to pretty much look for a reversal in the pandemic era bond buying, right? Where the Federal Reserve, the central bank, pretty much doubled its balance sheet almost, well, a bit more, I would say, from 4.2 trillion, right? That was a balance sheet before all this buying and all this quantitative easing started to nearly about $9 trillion on the balance sheet. So, unlike the larger rate hikes that are being forecasted by the Fed, which have been quick to capture everyone's attention realistically, right? We've been looking at that for a while now, investors and traders alike. And I always go to the countdown to FOMC. It's a FedWatch Futures website that gives us the probability of uh, rate hikes, right? So a 75 basis point rate hike, the probability of that in September is now almost 71%, right? It starts to increase day by day. Yesterday was a little higher, it was 75%. So still, there is some time until that happens. Quantitative tightening is more of it's a different way of tightening financial conditions. Um, they're unwinding the balance sheet. So what it's doing is cutting money supply from banks in a certain sense, which then trickles down to consumers and others. So what has happened in this last scenario is that they're not necessarily selling their treasury holdings outright, but rather the central bank is more so letting them mature to shrink that balance sheet. So after an initial few months at a slower pace, monthly caps of offloading treasuries and mortgage-backed securities are set double to 60 billion and 35 billion respectively, compared to the peak combined rate of 50 billion last time around when the Fed trimmed its balance sheet between 2017 and 2019. So this whole thing is somewhat more of a complicated accounting process involving sentiment windows and redemption caps, but at a basic level, it ultimately reduces the supply of bank reserves and drains money from that financial system, as I was just saying a bit earlier. So some safety valves have been implemented this time around, like the standing repo facility after chaos of the repo market prompted an early end to the QT program in 2019. And the new facility will allow primary dealers to borrow more reserves from the Fed against high quality collateral. But some caution, it may not be enough to stave off the liquidity issues and could complicate the Federal Reserve's and Jerome Powell's overall plan to raise rates and bring inflation under control. So we also have some insight here uh, sorry, let me see, these home prices as well. So that's another factor of all this inflation talk, right? It's not just the energy price that a lot of people have been looking at, but also we have shelter. right? Food, inflation, all those prices that have trickled up, those are things to look at. So home prices from the real estate side of things, housing market has come into focus at 9 a.m. as the S&P Core Logistic Case-Shiller National Home Price Index reveals trends for the end of the second quarter. So the data for June will highlight resales of single-family homes in 20 metropolitan regions across the U.S. at the start of a typically hot summer buying season. So we've seen those numbers trickle down for the most part, and many have recently weighed in on the industry, especially as the Fed continues to aggressively hike rates, and they say the fundamentals are still intact despite current volatility. So we've also seen mortgage rates increase. We've seen the application process for mortgages, the actual net number decrease drastically, and the demand versus supply aspect, right? The demand has been shrinking in this sector. So it's interesting to see average home rates reached 5.2% in Q2, according to Fannie Mae. Sorry, and while that represents a major increase from the 3.2% seen in the first week of January, it's still low by historical standards. And furthermore, mortgage rates are projected to decline next year, easing back to an average of 4.5% in 2023. So we'll see. Most of the worries in the housing market center around whether the U.S. plunges into a recession naturally, and in the event, Moody's Analytics forecasts that housing price will fall between 5 and 10%, and 183 overvalued areas. Properties could crash about 15 to 20%. So it could come as sales of new single-family homes slid to their lowest level in nearly 7 years in July, tumbling about 12.6% to a seasonality adjusted annual rate of 511,000. So it's not just in the U.S. Toronto's experiencing something similar as well. The Toronto housing market has been fairly inflated over the past 2 years as well, or I should say more than that, aggressively rallying. So this week, today we don't have much. We have that Case-Shiller home price index that has already come out, actually. So we can take a look at what that actual number is. We also have in the morning, we have consumer confidence at 10, which could be an interesting report, right? A blip in the market. I usually like to fade those moves, right? Whether it's a jolt down or up, it's probably a fadeable opportunity. We also have Feds Williams talking at 11, and then until the end of the week, we have a little more data. So let me just see. We are almost in September. Wow, this year's been just flying by. Let me see where this data is. I'm kind of interested in these home prices, and then we'll talk about. Maybe I can't even find it. Oh, geez. Is this what I'm looking at? So an actual, in terms of home prices, 18.6% versus the expected 19.2%. So a slight decrease in those home prices. So that's an interesting thing to look at. Also, if we're looking at the overall market here, giving you some levels into the start of this day for the futures. And some of these ETFs, right? I've been talking about looking at market maker positioning, and the market maker positioning recently is starting to open up a little more to the downside, I would say. I don't know why this isn't loading. And they're starting to open up positions for negative delta. There's an area at 40.72 on the S&P futures and 40.57 on the S&P futures. If prices remain intact below those areas, there could be a little more downside and try a little more aggressive sell into the end of the day. That's an area that I'm going to be watching. 40.40 to 40.43 on the S&P futures is a key area as well for the buyers to hold out. And so is the 27 to 30 area. But if we manage to close above 40.72-ish, 40.80-ish, I think that the buyers could really try this, and they're going to try to ramp it up. So those are two very pivotal levels for sellers to try to hold this thing under into the end of today, into the end of the week pretty much, and we'll see how those guys shape up. 72 already failed overnight, little double top there, and now we're trading into the 40s. So we'll see how these guys shape up throughout the remainder of the day. But realistically, Bears would win with a close under 40.30. Bulls would win with a close above 40.70 today. And just keep in mind the levels that I was talking about. 40.56 to 57 is going to be a huge pivotal area where market makers are trying to subdue price and try to push them lower. But at the same time, the 40.27 area is an area where they're trying to kind of pin price above. So just keep those in mind, and we'll keep an eye out on those today. A shorter update than normal, I would say, and we're getting ready to open up our live rooms now on both futures and options. So I hope to see you guys there, and we'll start this up again tomorrow. Hope everyone has an amazing trading day, and take care.